Welcome to Season 4 of the Knack for Business podcast.
I'm really glad we're having this conversation about tariffs, and you invited me here today, especially with the Canadian business community right now. I had a little bit about me. I've spent most of my career working with leadership teams when profit performance doesn't match revenue growth. And what I've learned over the years is that external forces rarely destroy margin. Lack of a structural visibility typically does within a business. Between Canada and the United States, we operate in one of the most integrated trade corridors in the world. And that integration creates opportunity, but it also creates hidden exposures. Tariffs are rarely just a tax. Yes, they are margin architecture issues for business. And last year, when we audited data across multiple companies, we averaged a 20 to 40% drawback opportunity due to miscoding, misclassifications, overpayments, and structured financial errors. And it's not a policy issue, it's a visibility issue into the actual tariffs themselves. So today I wanted to reframe tariffs not as a political issue, but as a profit strategy for business owners, leaders, and those that know business owners and leaders that have been impacted by tariffs either in this year or previous years. And so most small businesses and a lot of business leaders view tariffs as a compliance issue or a customs broker issue or a government issue. But what tariffs directly affect are the gross margins, the working capital, and ultimately the valuation of the business. For instance, a 5% tariff doesn't reduce profit by 5%. It has a ripple effect across the organization that, unless it's being watched, many people aren't aware of. It reduces your gross margin immediately. It increases cash tied up in your inventory. It often cannot be passed through to customers instantly. As we all know, we have systems and processes and software. We have to make those adjustments. We also have contracts that have to be considered. There are so many variables that need to be considered. It can also create distortion of pricing across segments as well, especially for those that are more price sensitive. And we'll get into pricing a little bit later. For a $10 million company operating at an 8% net margin, that cushion of variability is very thin. Even with a small increase in landed costs, can materially reduce the profit in that organization. So if you're an organization that currently imports or exports, the question I have for you is, do you know your fully loaded landed cost per SKU item in your portfolio of SKUs? It's not just the invoice price, it's not just the freight. The full landed cost, including duties, compliance, and working capital impacts. The question isn't, do tariffs exist? They exist, they're always going to exist. The question is whether the leadership in the business understands the full financial ripple effect of each of them. And so I'd like to break it down. When a tariff or a duty increases, the very first thing that happens is the landed cost rises immediately. Secondly, inventory valuation increases. Third, duties are paid upfront before revenue is collected. Fourth, pricing adjustments lag. And fifth, the gross margins of the organization compress. And if in your business, if tariffs increase tomorrow, how long would it take for you to adjust your pricing? Would it take a week, a quarter, a year? Most businesses do not immediately see the compression because it's absorbed in small ways. But over a few quarters, it's going to start showing up in your EBITDA. And here's where it gets more interesting. In many cases, the tariff rate itself is not the biggest issue. The biggest issue is that the classifications and the documentation are wrong. When we reviewed our filings last year, as I mentioned before, there was a 20 to 40% of duties that were overpaid. That means companies were unintentionally overpaying. And it might have been for a various number of reasons. They might have been misclassified HS codes. In an HS code, if you're not familiar, is the code of what the item is being tariffed or taxed at. If that code is incorrect, you could actually be tariffed at a higher rate than you should have been. A lot of times in the if there's a question about the coding of the actual product, the default will be to a higher classification to ensure that they're not under taxing for that product within the company. And then also failing to qualify properly under the United States Mexico Canada Agreement, or it's called USMCA. It is the trade agreement that replaced NAFTA in 2020. And in that agreement, it identifies if you fall within the agreements within that contract, your tariffs are reduced or eliminated completely. So it's critically important the HS classification of the product is correct and the filing for USMCA compliance is correct. Additionally, missing drawback opportunities on re-exported goods. A lot of times people don't realize when a tariff changes, the structure or the requirements of the tariff change, there is a small window of time where you can actually apply for recovery from previously paid tariffs. So every time a tariff changes, saying we need to reevaluate, is there an opportunity that we can go and draw back some of the tariffs we already paid? Then also, a lot of times businesses do not double check what their broker filings are doing. They're not auditing their broker filings. Brokers are, their priority is the compliance in moving the goods across borders. They want to make sure everything's compliant. They're not focusing on optimization of the products across the borders. So the question I would pose to business leaders is, have you reviewed your HS classifications in the last 2 years? If the answer is no, there's probably a good opportunity that you have significant funds and capital that can be drawn back from that. Many small businesses are unintentionally financing the government through overpayments, and most don't know it. Another question I have is if you could recover just 20% of tariff duties that you paid last year, what would that mean for your EBITDA this year? And then lock in the optimization of those tariffs for your organization. That drawback and that compounding additional capital is significant in most organizations. There's three mistakes that I see commonly repeated in businesses between that 1 million to 20 million in annual recurring revenue range. The first mistake I touched on a little bit is that assuming the brokers are optimizing for profit. They're not responsible for margin optimization. Leadership teams must own the economic impact of trade classifications. If no one strategically reviews the codes, the origin documentation, and duty structures internally, leakages occur quietly and sometimes year over year over year. The second mistake I see is treating tariffs as temporary. Cross volatility between Canada and the United States is no longer episodic. It's structural and it's not going anywhere. They predict the volatility is going to continue for a little bit, and we don't know how long the volatility will continue for. Smart companies are scenario planning. So they're modeling what happens if the duty increases 5%? What happens if they decrease? How fast can we respond? What happens if our sourcing shifts from the US to another country or from Canada to another country? The companies that are modeling the risk exposure before reacting are the ones that are preserving the margins in their organization. With the tariffs that were implemented last year, a lot of organizations were caught on their heels because they were implemented so quickly. Typically, tariffs are implemented with a planned approach in a timeline that can accommodate that. Because of the speed of the implementation of those tariffs, most organizations were left to pay the tariffs and to do it very quickly. That created a tremendous opportunity for the misclassifications, the compliance, all of that to fall to the wayside in the effort to align and adhere to the instantaneous tariffs that were implemented. The third area that I see most common is ignoring the working capital impact. And this is the most overlooked issue. Duties are paid before revenue is ever collected. That extends the cash conversion cycle. It increases the amount of capital tied up in inventory. And for smaller companies with limited liquidity buffers, this creates real stress. I've talked to small business owners where some of these tariffs put them in a significant financial position where they may not be able to stay in business because of the tariffs. And we're looking at different financial options for them. Many leaders monitor net income monthly. They don't monitor how tariff shifts. The tariff shift affects the cash velocity. And that's something that we're helping to quickly change and create insight within their businesses and where the tariffs are within that cycle of their business. And the cash strain often shows up before the profit erosion. The cash strain will be immediate. The profit erosion is going to take time to actually show up on the financial statement. And specifically between Canada and the US corridor, we frequently see the USMCA qualification errors that they should be qualified for it and they're not. The country of origin documentation that a lot of times we see is inaccurate. The chess codes have not been reviewed in years. And even with the same brokers, there is inconsistent broker activity and broker insight as well. And then again, the overpayment due to conservative classification. That overpayment is something that I pay real close attention to because that just is one of those challenges we really need to get our arms around to not overpay out of caution, but pay the exact amount out of data and having that information so you're making a very clear decision and we're not refinancing anyone else. In smaller organizations, trade data sits somewhere between finance and operations, and no one owns it strategically. Where no one owns it, no one's looking at it, no one's optimizing for it. And that's where those high numbers of drawback recoveries come from. And it's not because the companies are reckless, it's because they're busy running their businesses. And the tariffs are something that used to be a set it and forget it. And now it is come to the forefront where a lot of times people don't know how to optimize and how to manage it in a much quicker cycle, as we've seen. And some of the insights that most small businesses don't realize is that tariff leakage is often self inflicted. The biggest margin loss is frequently miscoded and misclassifications, not the tariff rate itself. Secondly, the tariffs can hit cash before they hit the income statement. And liquidity stress is the early warning sign. And most business owners I know, their cash flow is the priority of their business, where it should be. I talk to many business owners where the cash flow isn't the primary focus of their business. They're focusing on running their business and fulfilling their clients' requests. And the finances oftentimes are not as much of a priority as they should be. The smaller businesses and the larger businesses should be running their businesses by the numbers, by the finances, sometimes every morning. It is not unrealistic or unreasonable to request your financial status every single morning before you start your day. As a business owner, you should be aware of that. And then also, what is making up those numbers on those financial statements that you're seeing every morning? Not just the summary, but the details behind it. Not that you have to know them, but you do have to understand them and know where they come from. And that's where someone with the financial background, whether it's your accountant or a tax strategist, but someone in the financial space should be explaining those numbers in detail. And the business owner or leader should be questioning what makes up these summary numbers as well. And then the third area that smaller businesses, we tend to see a lot of activity is the buyers discount fragility more than cost. If a company is highly dependent on cross-border inputs, has no risk modeling or classification discipline, valuation is going to suffer. And it's not the tariff percentage, it's the structural exposure. So I hope that I have shared information that was valuable to everyone. I presented some questions that helped you better understand tariff management as a whole, maybe in your own organization or your client or colleagues' organizations, and maybe triggered some questions as well. In closing, trade environment between Canada and United States has never been more volatile. And the advantage does not go to the lowest cost operator. It goes to the most structurally informed operator. Tariffs are one lever of profit strategy. There's pricing strategy, cost to serve analysis, working capital disciplines, supplier diversification, and trade data ownership, just to name a few. When leadership quantifies these levers together, margin stabilization, even margin stabilizes even in volatility, and clarity precedes. The companies that design their profit architecture intentionally outperform those reacting to the headlines.
To reach the podcast hosts, email them at info@creativeinsight.com or by the website creativeinsight.com, spelled KREATIVISIGHT.com. To reach Wayne at his email, wayne@motive8u.ca, that is MOTIVE, the numeral 8 and the letter u.ca, or his website, motive8u.ca. If you would like to be a guest on this podcast and share your knowledge, let us know. We would also appreciate your feedback on the content or format. Check the show notes for more details. For these podcasts, we like to acknowledge the support and thanks to the following people. Carl Richards from Podcast Solutions Made Simple, a renowned podcast expert. Fred Crouch, who is the Property Wizard podcaster, where Bernie is a co-host. Jovan Strika from At Hive, a co-working space that is more than just a space. Then Melanie Weber, Bernie's invaluable business partner, and Wayne Pratt from Motive8U Inc., who serves as both a coach and co-host of these podcasts. Disclaimer. Please note that the Knack for Business podcast episodes are meant solely for educational and general informational purposes. The information and opinions contained within are not intended to be professional advice on any subject matter. The thoughts, views, and opinions expressed by the participants are their own personal beliefs and do not represent the views of the podcast hosts or any affiliated organizations. It is important to note that this podcast is not a replacement for consulting with certified experts in your area who possess knowledge of your unique situation. The hosts of the podcast, along with any participants or affiliated groups, do not take responsibility for any actions taken or not taken based on the information presented in this episode. It is highly recommended that individuals seek guidance from their own personal advisors in fields such as accounting, law, or other pertinent areas prior to undertaking any actions or making decisions that may impact their financial, legal, or other aspects of life.